So recently so many friends of us come to us to ask how to build a portfolio. They have their hard work money not working for them. They put it in a savings account, doesn't give much return. They're looking into real estate, but it's not very lucrative at the moment. They've also tried a couple of things, building a portfolio. For example, following advice from someone, buying one stock, losing a lot of money. Or it's just not really well planned out portfolio that doesn't give returns for the long run. And that is why we are here to help you build a responsible, profitable portfolio for the long run.
You are watching the How to Build a Portfolio series. I am Tom.
I'm Hannah.
This is the place to expand your mind and mind your business. Let's dive in. We used to be professional musicians, violinists, but we were looking for a way out, for a different career path. And based on the returns of our first investments in 2008, we were able to pay for our dreams and study the studies that we wanted to do. Today, I'm a surgical resident.
And I'm a psychologist. We are not professional traders. We will not give you any advice on any specific trade. We are here to help you learning about the ins and outs, how to build a profitable and responsible portfolio for the long run.
Now let's address a few basic questions about investing. Why should you even consider investing at the stock market? I'm sure that by now you've heard about investing into ETFs and stocks, as a lot of people around us are talking about this opportunity. Let's take a look at the development of the MSCI World Index of the last 20 years. Imagine if you would have put in 500 euros a month for the last 20 years, you would have invested a capital of about 120,000 euros. And today, this money would be worth approximately 300,000 euros. That's an average annual return of 5%. In my opinion, that sounds pretty interesting compared to other investment strategies. So once you decide to invest into the stock market, the next question should be, how long should you stay invested? To answer this question, let's take a look at an article that was published by the Capital Group, an investment management company. In this article, statistics were performed on the development of the S&P 500 index over the last 91 years. Now, if you would have invested into the S&P 500 index for a 1-year period over the last 91 years, in only 73% of the cases, you would have turned up with a positive return. However, if you would have decided to stay invested for 3, 5, or even 10-year periods, then your odds of getting a positive return would have increased dramatically to about 95%. So this analysis shows us in a very clear way that investing successfully is probably a long-term strategy. Now let's move on to the next basic question. When is the right time to step into the market? Let's go back to the same article by the Capital Group that I mentioned earlier. Here, two scenarios are described. In scenario A, investor A invests 10,000 euros per year for 20 years and picks the best market timing every single time. Investor B invests the same amount of money in the same time period, but always picks the worst market timing. Now let's compare the average rate of return of both of these investors. And we'll see that in scenario A, with the best market timing, investor A turned up with a return of about 9%. In scenario B, investor B turned up with about 7% average return. So it's not a big difference. So if you're in it for the long run, the timing does not really matter. Of course, there is a small difference. So I think being in it for the long run is much more important than wondering about the right market timing.
So now I would like to address another issue. What type of investor would you like to be? It's very important to ask this question beforehand, so you will be able to build your portfolio accordingly. This is important because you need to feel comfortable with what you're doing and you need to be able to sleep at night. If we would put it on a spectrum, on one hand you have an investor and the other hand you have a speculator. An investor will look for investments for the long run, for a couple of years, and he will go for moderate risk and moderate returns. He will never lend money for it and look really closely to the books. What kind of company is it? Is it viable? Is it a good investment? The speculator, on the other hand, will look at investment for a couple of weeks. He will expect high returns, he will take high risks, he will look at the charts, and he will use market psychology and lend or leverage money if necessary.
Now let's take a look at an example of our very own portfolio that we've built up in the last couple of years. On one hand, you will see that we've invested into quite a lot of large indices and other ETFs. On the other hand, we have invested in also quite a large amount of individual companies. And then there is a small part invested into cryptocurrencies and gold. If you think back about the types of investors, I think that we are positioned somewhere in between the investor and the speculator. Now, we're both very comfortable with our positioning in the middle of both spectral ends, because right at the beginning of our investing journey, we decided that we would pick a certain amount of solid investment picks with a moderate return and boost our total return with temporary high-risk investments. So our main goal is to provide you with the background knowledge and the right tools for successful investing so that you can take financial matters into your own hands.
If you want to dive deeper into this content, we have made a list with the sources below. And if this was helpful for you, please share it with a friend and hit the like button. Please don't forget to subscribe, never to miss an episode again. Thank you so much.